Thursday, August 17th, 2017, Monaco 64, home of alternative economics and contrarian views. So this morning I'll be looking at the market, do an update, but I also want to talk about the bond market and how the financial sector, our monetary establishment, the people who run the system, central banks, fund managers, stockbrokers, they're letting investors down through a fraudulent system. And why do I say fraudulent? Well, because the base, the most important factor, not only for bond markets, but for financial markets, is the interest rate on government bonds, which is considered a rate, the risk-free return on investment. And I'll show you how they're basically manipulating this interest rate. They're faking it through central bank activity, which means QE, and it's all like fraudulent. And the reason they're doing that is to keep indebted parties, especially big government, functioning. Because if they let the market take care of interest rates, if they reported the rise in prices, not in a fraudulent way, and by rising prices I mean their CPI basket, or in the UK you've also got an RPI aside from a CPI, and nowadays they call this inflation, but inflation is not the rise in prices. Inflation is the creation of money and credit out of thin air that results in the rising prices. And that's how they get away with it, because they keep telling us that inflation is running below 2%. But no, their phony basket, or the phony way they calculate the rising prices, that's what they use to tell you, inflation is below 2%. But that's not inflation. That's the result of the big inflation we've had, all the debt they created through QE, money printing, low interest rates, negative interest rates. And I'll look at shadowstats.com, and I'll put a link below to this website. John Williams, I've followed him for years, and he actually calculates, he compares how the governments, especially in this case the US government, calculates CPI now, which is considered inflation, much more differently than in 1990 and 1980, and how the cost of living is rising a lot higher than the 1.7% that they tell us. And I'll tell you also how that affects bond yields. I had an interesting message from Adrian. This is for Adrian. He wanted to know how inflation affects yields, or also default risk. And that's why I'm doing this video about bonds and how, they're conning investors. They're basically stealing from investors, because investors are not getting a proper return on their money, especially with the way money has been debased. We do have massive rising prices. We have massive inflation. Inflation is not the CPI. First of all, though, now let's just have a quick look at what the markets are doing. It's around 8:30 London time, 8:30 a.m. Spot gold, which really turned around really well yesterday, continuing to do well this morning. We're near the recent highs of 1292. We got up to a high of 1290 overnight, a low of 1282. Right now we're at 1288.50, up $5.50. Silver 1715, up 3. Range has been 1707, 1720, and silver did really well yesterday, up about 50 cents. High grade copper, which is something I'm following closely here, because of silver, we're just under that $3 level. We're at 297 right now, up 3/4 cent. So and we got up to 299. So copper knocking on the door there. The Dow is up 4.5 points, 22,030. S&P 2,468, unchanged basically. Oil $47. Crude WTI. The pound is virtually unchanged, 128.93, and the euro 117.60. Euro rebounded well yesterday as well, down 5, and the dollar is down against the yen here, below 110 now, 109.94, down 0.25%. So yeah, looks like the dollar has turned back down. Maybe, you know, as I said, I think it's a dead cat bounce. So and the precious metals and the manipulation we see in precious metals through the years, one of the reasons they do this manipulation is to convince investors that there is no inflation. And the other way they do that is through manipulating the statistics and also changing the you know, the vocabulary, basically saying that inflation is a rise in prices, which it isn't. Inflation is the creation of money and credit and loose monetary policy that leads to higher prices. So they've even changed the definition of the word, and everyone now's, you know, even economists and fund managers, reporters, CNBC, when the CPI number comes out, they say, oh, inflation came out. That's not inflation, and that's how they get away with it. And there's a term called fiduciary duty, and that they're failing on their clients. The investment business, the investment world, Wall Street, the City of London, they're complicit in this. And even though they have all these tests, these courses, CFA, take your CFA, you'll be qualified to give advice, but they don't look at in the CFA courses at the fact that statistics are being totally manipulated by the governments, and that investors are being, raped basically by the central banks and the investment, managers. The investment managers don't care because they get their fees every year. They're managing billions. They get like 0.5% of that. They're fine. They don't care about their customers. They don't care that they're losing purchasing power. And yes, gold has been down in the last 5 years. But for example, if you look at gold in pounds for the last 10 years, it's still up 201%. So in the long term, gold still protects investors against inflation. And by inflation, I don't mean rising prices. I mean the debasement of the currency, which leads to higher prices. So yeah, let's have a look at Shadow Stats and John Williams. And I've got here on the screen alternate inflation charts. So he compares basically how the US government used to calculate CPI back in 1990 and 1980. So it's 1990 based CPI. You can see that if the US government calculated CPI how they did in 1990, right now the CPI would be just under 6%, but it's under 2%, the official CPI now. And then he goes on and looks how if the government calculated CPI how they did it in 1980, the CPI would be just under 10%. So I won't go through what they've done to, well, I'll go through it a little bit, but a lot of it is called hedonics, which basically means they say that, cars are better, nowadays. So if the price of the car goes up, it's because of improvement. So they actually don't calculate the rise in the prices. There's a lot of other things that they do to, and they've basically fudged this statistics, So according to, John Williams, if you look at like in 1981, the CPI was around 15%, and the 10-year yield got up to almost 16%. So that's what bond yields are supposed to protect you against the rise in prices resulting from inflation. But if the government lies about the rising prices and investment advisors and professionals and central banks go along with it, people will, price bonds. The 10-year yield right now is around 2.2%. The CPI is around 1.7. So it's, they're saying, oh, the 10-year note is protecting us against inflation, they call it. But it's not. Because as you see, prices are rising at almost 10% if you calculate it like they did in 1980. Or they're rising around 6% like they calculated it back in 1990. So what has changed since 1990? Of course, there's been technology, but, why fudge the numbers? So yes, the bond yields include inflation, the rate of inflation, which is the increase of money and credit, but now they say it's CPI and they fudge the CPI. So actually, this bond, it is a bond bubble. And I think Alan Greenspan, who spoke a few weeks ago about there being a bond bubble, he knows about this. He knows very well that the government is lying about, how much the dollar and all other currencies, they do this in all other countries. I remember in Germany in the 90s when, I traded a lot of German government bond for clients, futures, and we used to follow what was called the cost of living data. The Germans used to call it cost of living. That's how much the cost of living went up. They didn't call it inflation. But now, even the Germans, they don't call it cost of living anymore. They call it CPI. Yeah, and the same thing in the UK. In the UK, up until the Labour Party, back in the 90s, they used to have something called the Retail Price Index, or RPI. They still have that. But when the Labour Party came to power in 1997, they changed that and they created CPI. And CPI has always been lower than the RPI. So the latest numbers for CPI in the UK, which they also call inflation but isn't, came out at 2.6%. But the RPI number came out at 3.6. And that's what they used to use to calculate, their definition of inflation. Even the core RPI came out at 3.9, so almost 4%. I don't think John Williams does a shadow stats for the UK, but as you can see, the core RPI, which excludes food and energy, which is still going up in the UK, was almost 4%. And despite that, the 10-year yield in the UK, the gilt, is only 1.09%. So you're crazy as an investor, a long-term investor, to buy that and receive only 1% when the cost of living or inflation is running over around 4%. And investment advisors, fund managers, stockbrokers, they're failing their clients by advising them to buy gilts. So yes, Adrian, that's how normally bond yields should be calculated. They should embed the rise in prices, which is not inflation, but is the result of inflation. And that's why they've been, they try to manipulate the precious metals. They do succeed in the short term, but in the long term, precious metals will always protect against inflation. Because what is inflation? Inflation is the creation of money and credit out of thin air. And if they create more paper money, then at a faster rate than gold and silver, of course, gold and silver will go up against that paper money in the long term. It's the law of supply and demand. Very simple. But they've changed the definition of everything. So yeah, I really recommend shadowstats.com. I'll put the link below. If you enjoyed the video, please like, share, subscribe to my channel. And yeah, you can follow me on steemit.com and also on Twitter at Maneko64. And I'll talk to you later. Bye.